And welcome back to Managerial Accounting. Purpose of this little mini lecture is to review the solutions to exam number 2. So the first thing you'll notice on the front page of your exam booklet there is your to get your grade. I took the number of questions you got right, and they were a total of 32. So number of questions you got right divided by 32. So if you got all 32 right, the fraction I would have had was 32 divided by 32. And then I multiply that by 40 points. So if you got every question correct, you would have scored a maximum of 40 points. If you didn't get every question right, I took the number you got right, divided by 32, and then multiplied by a fraction. So if you didn't get them all right, then you got some fraction of 40 points. Then to that, I add your scores for each of the 6 questions, which are all worth 10 points each. And if you have difficulty reading my handwriting or you can't figure out how I came up with your score, just see me after class and I'll be happy to walk you through it. Okay, so the thing with the multiple choice questions here is there are key phrases that are kind of important. So if there's a key phrase that is important, I've highlighted it in yellow. And then I've also highlighted in yellow the correct solution. So what's highlighted here for number 1, which of the following explains why this approach is misguided? And so what the company has decided to do is to consider support department costs to be facility level costs that don't need to be applied to products. Well, what's wrong with that? Well, the product cost may be inaccurate because support department costs may be used more heavily by some departments or some products than others. So if the support department are used more heavily by certain products than others, then they should be allocated as should be allocated. Okay, number 2, joint costs are costs that are inseparable before split off. That is the definition of a joint cost. Remember the story about the little pig in New Hampshire before being sent off to be dressed, all those costs that they had to get the pig ready to be dressed. So the answer there is A. Which of the following are the 4 common methods for allocating joint costs? Well, the 4 common methods are market value at split off, physical units, weighted average, and net realizable value. Under net realizable value of allocating costs, which of the following equations is used to compute the value of products not processed beyond split off? Well, if they're not processed beyond split off, it would be the selling price at split off times the quantity. So the answer there would be A. Key phrase there, products not processed beyond split off. If they were processed beyond split off, then you'd have to consider the additional processing costs. But these products were not processed beyond split off. So the correct answer there is A. Which of the following is a drawback of using a single plant-wide rate to apply overhead to product costs? Well, using one single driver, very likely that a single driver used for all overhead costs is unlikely. It's likely to be inappropriate for every type of overhead. So some cases you use number of employees, some cases you use square footage, some cases you use hours. So answer there is B. 6, which of the following explains why it's difficult to apply support department costs such as janitorial services to products? Well, it's often difficult to come up with the appropriate cost driver. So the answer there is C. So again, you have to pick the answer that is the best of the best choice, and that's the one that is the best choice. So answer 6 is C. 7, Woodbridge manufactures wax line takeout containers for food service industry for many popular restaurants. Which the following is most likely to be a support department cost? Well, these other ones here, deli department, sandwich department, salad department, those are all products. So the one that is the support department would be the janitorial department. So the answer there is B. 8, which of the following statements is true about sequential method of allocating support department costs? Well, the sequential method captures some, but not all inter-support department costs by allocating support departments to other support departments and production departments in a series of steps. So that is how the sequential one works. So the answer there is B. Number 9, Most operating decisions of management focus on a narrow range of activity, and that narrow range of activity is called the relevant range. So those first 8 questions were from Chapter 5. Now we'll get on to, and the next 8 are from Chapter 6, the next 8 are from Chapter 7, the next 8 are from Chapter 8. Question 10, the point where the profit line intersects the horizontal axis on the cost volume profit, that is the break-even point. The point where the profit line intersects the horizontal axis on the profit chart. Remember, the profit volume chart is we've got volume going up and we've got profit as the vertical line. So that would be the break-even point. Number 11, Piper Technologies fixed cost. So they give us the fixed cost, they give us the selling price, and they want us to figure out what is the number of units that I've got to sell to actually not break even, the number of units I want to sell to earn a profit of 200,000. So it's 1,500,000, which is the fixed cost, plus the targeted profit, divided by the amount that the contribution we get for each unit. So we've got sales price of 250, we got variable costs of 130, so we come up with 14,167. So whenever you have to do calculations and there's multiple choice options, do the calculation first, then go looking for your answer. So the answer there is A. Which of the following would be classified as fixed costs for a t-shirt manufacturer? Well, these are all electricity, hourly wages, cloth, those are all variable costs. So the answer there would be none of the above. So notice the electricity here is we've got the actual amount per kilowatt hour. So the more kilowatt hours, the more the electricity. So those are all variable costs. So none of them are fixed costs. 13, in a cost volume profit chart, the total cost begins at the fixed costs on the vertical axis. So that one is true. There's other ones, total cost lines begins at 0. No, the total cost line begins at the fixed cost. Slope of the cost line is dependent upon fixed cost per unit. No, the slope is dependent upon the variable cost per unit. Total cost line normally ends at the highest sales value. No, that's not true. So the best answer there is C. 14. Which of the following conditions would cause the break-even point to increase? Now, the break-even point is the fixed cost divided by the contribution per unit. So if you increase the variable cost, then the contribution per unit gets smaller, and therefore your break-even point would increase. So the answer there is D. 15, as production increases, the fixed cost per unit comes down. As production increases, fixed cost per unit. You want to get fixed cost per unit, you take fixed cost divided by the number of units. So if you increase the number of units, then fixed cost per unit comes down. 16, which of the following is an example of a cost that stays the same as the number of units produced changes? Well, that would be depreciation would remain the same. All those other things would go up as the number of units change. So answer there is C. 17. Which of the following is a reason for easy identification and control of variable cost under the variable cost method? Well, all of those things. So variable and fixed costs are reported separately. Variable costs can be controlled by management. Fixed costs such as property and insurance are normally the responsibility of hire, not the operating management. So all of those things are true. The answer there is D. Contribution margin ratio is computed as contribution margin divided by sales. That's the contribution margin ratio. So the answer there is B. The amount of income under the absorption costing will equal the amount of income under the variable costing. Remember the little chart I put there. The only time they're going to be equal is if when the number of units produced is equal to the number of units sold. If you have in the change of inventory, one method will give you whatever you produce more than you sell, or you sell less than you to produce, you're going to get a different answer. But they'll be the same when the number of units produced and sold is the same. All has to do with the fixed cost included in the inventory, which you'll see when we get to the problem on variable costing, on the variable income statement. Okay, number 20. Under the variable costing, which of the following would be included in the finished goods inventory? The finished goods inventory under variable costing would include all the variable costs. Those are all variable costs, so the answer is D. The amount of income under absorption costing will be more than the amount of income under variable costing when the units manufactured exceeds the units sold. Okay, because if you produce more than you sell, then the fixed costs that are included in the inventory are not actually expensed, they're included in inventory. So whenever you produce more than you sell, and you'll see this in the problem we'll do shortly, absorption costing will give you a higher net income than variable costing, because variable costing expenses all fixed costs, doesn't include any of them in inventory. 22, on the variable costing income statement, the figure representing the difference between manufacturing margin and contribution margin, well, that's the variable selling and administrative expenses. Difference between manufacturing margin and contribution margin. So once you get the manufacturing margin, you have to subtract out the variable selling and administrative expenses to get the contribution margin. So the answer there is D, as in dog. 23, which of the following would be an inappropriate activity base for analysis in a service firm? Well, the service firm wouldn't have inventory, and that's why the service firm is a firm that doesn't buy and sell inventory. They provide a service. So the one that would be inappropriate for a service firm would be inventory produced, because they don't have inventory. 24, which of the following is required by generally accepted accounting principles? Well, very generally accepted accounting principles, as far as the inventory, requires us to use absorption costing. So we have to, if we have fixed costs, the fixed costs have to be included in the cost of the inventory. So absorption costing. Number 5, this one's a little bit complex. Trying to decide how many units of merchandise to produce each month, and then they tell you what the company policy is. So basically what you need to do here to get the number of units that must be produced is you've got to take the number of units sold, and they want this for the month of September. So this is the number of units sold in September. This is the number of units I want to have on hand at the end of September, which is 20% of the units that I plan to sell in October. So we plan to sell 40,000 units in October. So we're going to have 20% on hand. And then you have to subtract out the inventory that you had at the beginning of the period. And the inventory you had at the beginning of the period would have been, so August, September. So beginning September, you would have had 20,000. So you multiply that by 0.2. So if you work it out, you get 24,000 units. Number of units that must be produced would be the number you plan to sell, plus the number you want to have in ending inventory, minus the amount you had in beginning inventory. So the answer there is 24,000. Again, whenever you got multiple choice that involves calculations, do the calculations first, then go looking for your answer. Okay, so here, they're just asking us what the total selling expenses were. So you have to look at all these costs here and figure out what the selling expenses are. So sales commissions is 5% of $1 million. Sales manager is 80,000. Selling advertising expenses are 65,000. Shipping expenses are 1% of sales. And what else we got here? Miscellaneous selling expenses are 2,100. So if you put them all together there, add all those things together, you get 217,100. Okay, so basically, to get all the selling expenses, you've got to basically add those up. Some of them they've given you the numbers, some of them they're expressed as percentages. So the answer there is A. Okay, next one, relative to the cash budget. The cash balance is 290,000, and it has a minimum cash requirement of 340. The following have been reported. So what they want to know is, what is the amount of the deficiency or excess of cash after considering the minimum balance? So you started out with 290,000, okay, and they're asking us for the month of January. So you started out with 290,000. You have cash receipts of 1,1061,200. You have disbursements of 984,500. So that means you'd have 366,600, and the required minimum cash requirement is 340,000. So you would have an excess of 26,700. So the answer there is A. 28, which of the following is an integrated set of operating and financial budgets for a period of time? We call that the master budget. Disadvantage of a static budget, well, it doesn't allow for possible changes in activity levels, so the answer there is C. Which of the following estimates the number of units to be manufactured to meet budgeted sales and desired inventory level? That's by definition a production budget. Which of the following should be ignored when preparing the cash budget? Well, the one that's ignored is depreciation expense, because depreciation expense doesn't involve the use of cash. It's just spreading the cost of an asset over its useful life. That's not a cash expense. And the primary budget in a non-manufacturing business for a non-manufacturing business would be the staffing budget. Answer D. Okay, so that's the multiple choice. Now let's get to the problems or the opportunities. All right, so determine the dollar amount of the janitorial cost to be allocated to. So the department information for 4 departments for Samoa Industries is as follows. Samoa uses the sequential method to allocate support costs, first allocating the cost from the janitorial department. So we've now got to allocate the janitorial department. So when you allocate the janitorial department, you've got $150,000 worth of cost, and how you would allocate janitorial department would be based on the square footage. So you work through, so the cafeteria has 20,000 square feet, the cutting has 4,000 square feet, and assembly has 16,000 square feet. So you put, therefore, 50% goes to cafeteria. And then the next one, let's see, and then for the cutting department, that works out to be 10%. And then the last one there is the assembly department, and the assembly department ends up being 40%. So there's your allocation, 75, 15, and 60. Sequential method, and allocate janitorial costs on the basis of square footage. Okay. This next one actually was pretty simple. So using the net realizable value method. So the net realizable value method here, we told you that the face cream had a net realizable value at split off of 75. The other one had 35, and the other one had 4,000. So you simply add those up, and that's how you allocate it. Okay, so it's total cost we've got to allocate there. You get their share. Divided by the total net realizable value. Okay, the total costs are 200,000, the joint costs, so they're allocated on the respective net realizable values. So you get 100,000, 46,000, and 54,000. So that's allocated on the basis of net realizable value. Okay, next one here, this one is break even, but we have more than one product. So you've got to come up with a composite break even point. So you need the composite sales. So the composite sales, so we have 60% of product S and 40% of product T. So there's my composite sales price. And you got to get the composite variable costs. So my variable costs are $24.56. And you got to go 60% of one and 40% of the other. So you get $36.80. So the unit contribution margin is $9.20. So the break-even point, therefore, is 202,400 divided by 920, or 22,000 units. So there's the break-even point, and the number of units there. So it's of those units, 60% are going to be product S, and 40% are going to be product T. So hence 13,200 and 8,800. And then the sales necessary to achieve an operating profit of 119,600. So you take the break-even point, you add 119,600, you divide by the contribution per unit, and you get 35,000 units. Okay, this next one, you knew it was coming, is the budgeted cost of goods sold. Now, wait a minute, this one is prepare the income statement using absorption costing and prepare the income statement using variable costing. Now, the difference here between absorption costing and variable costing has to do with the treatment of fixed costs. So under absorption costing, the fixed costs become part of the inventory, under the variable costing, all fixed costs are simply considered period costs. And when we compare the two answers here, remember, if we produce more units than we sell, which is the case here, we produced 50,000, we sold 42,000. That means we've got 8,000 in inventory. So absorption costing is going to include the fixed costs of manufacturing in that ending inventory, whereas the variable costing is going to treat all fixed cost as period costs. So you're going to get a higher net income under absorption costing when you've got an increase in the inventory. When it comes to the inventory, the variable costing is only going to consider the variable costs of the unit. So you produced 50,000 units, so that's 575,000 divided by 50,000. And for absorption costing, you're going to include the fixed cost. So it's 655,000 divided by 50,000 to get the cost per unit. So you'll get different answers there. All right, and here's your selling and administrative expenses. Remember that all fixed costs under variable costing are treated as period costs. So here's absorption costing. So it's simply the sales, which was given at, you have to figure out, is 756,000. Okay, so $18 a unit times 42,000 gives you the 756. Then you have to subtract out the cost of goods sold. So it cost us 655,000 to manufacture this stuff, but I got an ending inventory. Scroll down here below. I got an ending inventory of 8,000 units. So 655 divided by the 50,000 produced times 8,000. That's where I got my 104,800 for my ending inventory. So there's my cost of goods sold. So sales minus cost of goods sold gives us gross profit, minus selling and administrative. We don't really care whether what's fixed and what's variable at that point. And that gives us operating income of 160,300. Now, you know absorption costing is going to be higher because you had an increase in the inventory. So now variable costing, remember, you treat all fixed costs as period costs. They're not inventory. So there's your sales figure. The ending inventory under variable costing only includes the variable costs. So the variable costs are only 92,000 units in the ending inventory. So 575,000 divided by 50 times 8, that gives you your 92,000 for your variable cost of goods manufactured. So your gross, your manufacturing margin here is 273,000. Subtract that variable selling and administrative expenses. There's your contribution margin. Subtract out all the fixed costs. And you'll notice here, as we predicted, your operating profit is less than it was under absorption. So under absorption, it's 160,300. Under variable, it's 147,500. Why is that different? Because we're not including the fixed costs that are part of the inventory. Ending inventory under absorption are not considered part of the ending inventory under variable costing. All right, here's the one where you've got to do the cost of goods sold budget. So most of you did pretty well on this one. So then that little template that I gave you hopefully looks like it was helpful. So again, I contrasted when I taught this talk, I contrasted a manufacturer to a merchandiser. So a merchandiser would have beginning inventory plus purchases gave us goods available for sale, minus ending inventory gave us cost of goods sold. So if we were dealing with a merchandiser, we would just have this column here. Okay, but we're not. We're dealing with the manufacturer. So we have to figure out the cost of goods manufactured, this line here. How do you get cost of goods manufactured? Right? So to get cost of goods manufactured, you have to consider the beginning work in process inventory. You have to consider the ending work in process inventory. And you have to consider all the different manufacturing costs this period. So the manufacturing cost this period would be the materials costs. So you have to do a calculation itself to figure out what the materials were. So here was your beginning inventory materials. Here were your purchases. That was the materials available. There's your ending materials. So there is your cost of materials put in production. Add to that direct labor, add to that factory overhead, and those are your total manufacturing costs this period. You add those manufacturing costs to the beginning work in process, and that is the total work in process during the period. subtract out the ending work in process inventory, and you'll get your cost of goods manufactured. So correct answer here. And then you, as far as the finished goods, here was the beginning finished goods inventory. There was the ending finished goods inventory. So you come up with a total cost of goods sold of $983,000. And the last one here is just a simple cash budget. So we collect 75% of the cash from sales in the month of the sale, and we get 25% come from the previous month's sale. So what are the budgeted cash receipts for April? So in April, we sold $225,000. We're going to collect 75% of that. And we're going to have so it's 25% from the month of the sale and 75% from the month following the sale. So in April, we had with the collections for March are going to be 75% of the sales for March. So March was 225,000. Multiply that by 75%, and then you got the collections for April. So April sales were 250, and you got 25% there. So your total receipts are 231,250. And the rationale for that, you collect 25% of the sale in the month of the sale and 75% the following month. All right. So in the month of April, you're going to collect 75% of March sales, and you're going to collect 25% of April sales, giving you a total of 231,250. Okay, so that's it, folks. I hope you enjoyed that review. If anything doesn't make sense, see me after class, and I'll be happy to explain it to you. Be well, everybody, and we'll see you on Thursday. Enjoy the homework.